And welcome back to the show this morning. It is 6:33 as we kind of get the day going here. Of course, you're listening to the Voice of Texas. I'm your host, Lance Roberts, for the Lance Roberts Show. And you can get all of our podcast videos and more at our website, lancerobertsshow.com, or simply realinvestmentadvice.com. Either way, get you the same place. On the phone with us right now, actually on Skype with us right now, is Michael Lebowitz, bunkered down in the midst of freezing cold snow. Mike told me a funny story last night that, I was talking about my wife earlier. She takes really good care of me and wants to, make sure that I'm well fed. Mike was telling me last night his lovely wife brought home steaks for him for dinner last night.
Were they frozen?
Well, yeah, they were coming in from the store, so they were probably already partially frozen.
Trunk.
Yeah, but so Mike's telling me, he's like, "Oh, my wife just brought me home steaks." And I was like, "Oh, that's wonderful." He goes, "Lance, think about this." He says, "Where do steaks get cooked?" So actually, Mike, how did that go last night?
So so you haven't heard the rest of the story?
Yes, I have not.
So I go to light the grill. I have a big green egg. I go to light the grill, and I can't lift the lid. The lid had frozen to the bottom part. We had some wet snow that was followed by, 0-degree weather. And the lid, I could not lift the lid at all. So I had to cook them on a griddle inside.
There you go.
But they were delicious. They were delicious.
My wife has mastered the art of now cooking steaks in an iron skillet. And that's it actually turns out pretty well when you do it the right way. But but it was funny because Mike's up in Maryland, so they're right in the midst of this whole Arctic blast that's going on. So I'm glad you're surviving okay, though. That's a good thing.
Yeah, and thank you for having your 60-degree weather right before I come on. It makes me feel good.
Hey, I keep telling you, move down here. It's great.
August.
You don't have to shovel snow. Okay, you got to give up a little every now and then, right? You can't have everything.
August is not a problem in the world's most air-conditioned city in the world.
That's absolutely correct. Hey, Mike, we got a lot of stuff to get into here. Talking about the Fed yesterday. It was interesting that yesterday we had expected from conversation that Jerome Powell, chairman of the Federal Reserve, had become more concerned, or at least had come under pressure, particularly from Donald Trump and the White House through a variety of pushes, in public notice about potentially not being happy with the Fed chairman's actions of raising interest rates and reducing the balance sheet, which had impacted the financial markets in last year in 2018, but also pressure from the member banks of the Federal Reserve, obviously filtering into his thought process about the economy, the strength of the economy, concerns about rising inflationary pressures. Yesterday made the announcement that kind of surprised a lot of individuals. Everybody expected him to maybe be a little bit more cautious about the economy and the process of raising rates and reducing the balance sheet. But yesterday was really kind of a 180-degree reversal. Your thoughts?
Yeah, what's interesting is he didn't really have good excuses for why he was doing it. He mentioned a government shutdown. He mentioned some global slowing. But he didn't really explain why he was doing such a large pivot. There were a few big takeaways. One of them was that he said that they were going to be patient with future adjustments to the target rate.
Right.
So they were expected to raise rates 2 to 3 times. That's according to their own projections.
Right.
Through the course of 2019, and I believe 1 or 2 more in 2020. He inserted the word patient, or the Fed inserted the word patient into their statement, which to us and I think to the market means that maybe they will, maybe they won't, but they'll wait to see what the data shows them.
It's kind of interesting, though, too, because the market is predicting basically no more rate hikes in 2019. So, while
Right.
they're talking about being patient, the market's suggesting that there's going to be no rate hikes whatsoever based on that kind of pivot in the language. But it's interesting because, we just had a very strong jobs report. We are seeing wages rise finally after, almost a decade. We actually are seeing wage increases to some small degree anyway, but you are seeing wage pressures. You are seeing labor pressures, et cetera, that are suggestive of higher rates of inflation in the economy. And, while the Fed has raised rates over the course of the last year or so, we're up to 2.25% right now on the Fed Treasury, on the Fed lending rate. The issue is that we're still way below where we should be if inflationary pressures are what we are seeing early in the pipeline. I mean, in other words, the Fed may be putting themselves too far behind the curve again.
Right, right. They run the risk that we do get some inflation and that they put themselves, like you said, behind the curve, and they have to increase sharply, and that's going to be very upsetting to the market. The other thing that came up yesterday was the QE. So that's quantitative tightening, quantitative easing.
Right.
And that refers to their balance sheet. Quantitative easing is what they did in 2009, 2012, 13, when they increased the size of their balance sheet by printing money and buying treasury bonds.
Right.
Over the last couple of years, they've actually been reducing their balance sheet, and the pace at which they're reducing it has been increasing. Over the last, I think it was since October, they increased it to $50 billion a month, which is a big number. But when you look at the graph, as Lance and I were joking about yesterday, it's really they're not taking much off it. But nonetheless, $50 billion is a lot. And on December 19th, so a little more than a month ago, Chairman Powell said that the removal of liquidity via QT will be on autopilot. Today, he basically, or yet last night, basically in no uncertain terms, he said, we're not on autopilot anymore. We'll wait to see what the financial markets are doing, what the economy is doing, and then determine the pace at which we will remove liquidity from the market. And that was, to me, that was the big 180.
Right. Yeah, and what I was going to say is that was the big moment. That was the big shift, which in 30 days, you have this complete shift in attitude. Now, what's interesting here is we've talked to a lot of people here on the show about Jerome Powell and how he was a different animal, and the markets needed to get used to this guy who's very different than Janet Yellen, who was a big proponent of supporting financial markets, zero interest rates, who was much like Ben Bernanke, very favorable for lots of liquidity, lots of low interest rates help support markets because higher asset prices lead to better consumer confidence, etc. Makes complete sense. But Jerome Powell was actually believed to be different. And the risk, I think, in this is that when you're running things where you are running zero interest rates, lots of liquidity into the markets, you do that when markets are under a lot of pressure, right? These are called emergency measures. We do this when there's a financial crisis type event and you're running emergency measures. When we did this previously, the markets responded very positively because you had low valuations, basically. I mean, we'd had a big reversion in 2008, and valuations were 12, 13 times earnings. And the Fed balance sheet was about $900 billion at the time, and Fed funds rate was 4.2%. So Fed funds rate went from 4.2 to zero. The balance sheet went up 200% to $4 trillion, and valuations have increased back to some of the second highest, on a trailing basis, second highest level on record. So you've had this big increase in valuations going up or higher asset prices, and that's benefited the economy, that consumer confidence, et cetera. But now the problem is that without undoing any of that, if we don't continue to raise rates, if we leave rates at 2.25% or just somewhere in this range, if you don't reduce the balance sheet, when you have the next crisis, what is going to be the effectiveness of these programs to help once again kind of recover and support the markets, because you didn't reload the cannon, so to speak.
Right. I have two thoughts on that, Lance. First one is just a rhetorical question. What if Jerome Powell knows something that the rest of us don't know, and that he is moving back towards more emergent? We're still in emergency monetary policy, in my opinion,
right? Just
less so than we were over the last decade. What if he knows something that we don't know? Don't know what that would be, but I'm just throwing it out there.
Right.
That's something to consider. The other thing to consider is that Jerome Powell knows that dropping rates to zero will not do much for the economy, or the markets for that matter. It'll help the markets on a margin, but it's not going to do much for the economy because the burden of debt is already too much.
Right.
So he knows that QE is going to be the next tool, and this was alluded to yesterday as well. QE will be the next tool, and he is not a huge proponent of QE. So if I'm Jerome Powell, I have to figure out a way to be a politician. I got to say a lot of words that are friendly, that we're going to not do QT as much as we were. We're going to be very friendly for the market. We're going to be dovish. But what if at the same time he's able to keep doing $50 billion a month, but talking the talk so the markets don't freak out?
Right.
And that's kind of my hope here, is that that's what Jerome Powell is doing. He's kind of talking out of both sides of his mouth.
Well, and that would not be uncommon to the Fed presidents that we've all had before. Janet Yellen, Ben Bernanke, and probably the most famous Fed chairman to be able to talk out of both sides of his mouth. In other words, think of a complete speech and nobody be able to understand exactly what he said. Of course, that was Alan Greenspan, who is the master of Fed speak and has had nobody come near him in terms of his level of ability to do that. Mike Lebowitz has an article out this morning on our website. We actually posted it yesterday for all of our RIA Pro subscribers at riapro.net, but we're actually posted a free version of it this morning on the website at LanceRobertsShow.com, realinvestmentadvice.com, talking about yesterday's announcement, what was said, what was meant by it, and of course it's a good piece of analysis for you if you want to get caught up. That's on the website now, realinvestmentadvice.com. Michael Lebowitz, CFA. We'll be right back after the break. We're going to wrap up the show, get your top headlines of the day, get you started for work. Don't go away. More of the Lance Roberts Show coming up next, right here on the Voice of Texas.
Get daily investment news you can use, delivered at the speed of the internet. Sign up for Lance's newsletter now at LanceRobertsShow.com.